everyone, and welcome to the agenda. I'm delighted to be here for a special episode about the Spring Statement. I'm delighted to be joined by Dr. Gerard Lyons, former economic advisor to the Mayor of London, Boris Johnson, who's now, of course, Prime Minister, and the Right Honourable Ruth Kelly, former Cabinet Minister in the Blair and Brown governments. And I'm Connor MacDonald. I'm the head of economics here. This Spring Statement was delivered amidst quite a lot of economic uncertainty. In the OBR forecasts that were also released today, they indicated that there was, in fact, a huge amount of uncertainty in their own projections. So I suppose in that context, my first question is actually a difficult one to my interlocutors today, and I'm just wondering what they make of the overall economic picture in the United Kingdom at the moment. Dr. Lyons, Gerard, why don't we start with you?
Okay, well, it's great to be here. Well, the OBR's new forecast today really captured the latest economic developments. Compared to their previous forecast last October, the OBR, Office for Budget Responsibility, effectively halved their growth forecast for this year and almost doubled their inflation forecast for this year. So the economy is taking a significant hit, largely because of external events, but also because of a slow policy reaction here. And it was against that backdrop today that the Chancellor announced some welcome targeted measures to ease the cost of living crisis. But despite those welcome measures, they only partially offset some of the previous tax increases already announced. So to conclude the answer to your question, we face a severe cost of living squeeze in the UK, which is the result of higher inflation, higher fuel and energy bills, and previously announced tax increases that were only partially offset today.
Perfect, thank you. And Ruth?
Yeah, that's absolutely spot on. I mean, the OBR also pointed to this being the biggest hit to living standards that they've ever seen, that there's ever been on record. And the budget clearly took place in that context and in the context of a war in Europe. So particularly uncertain times. Not surprising, perhaps, that the budget forecast for growth has been revised down significantly to be only around 1.8% on average over the next 5 years, and that inflation is likely now to peak at around 9% towards the end of this year and remain high for some time. So very uncertain times, huge political pressure to deal with the cost of living issues, and Rishi Sunak went some way to mitigate some of those, but could have gone a lot further. And then the long-term problems relating to the economy remain. So as Rishi is very aware, and as he set out in his May's lecture, the UK has a long-term productivity issue, and productivity growth has stagnated since the financial crisis. So it was good to see him recognise that as a real issue and start to make some changes to address that.
Thank you. That's a really interesting point on productivity. And to that point, and then the broader economic framework, it's clearly quite a difficult, volatile time. But the Chancellor, in the statement, made very clear that he's going to stick to his fiscal rules. Given the uncertainty, why do you think he's done that? And do you think that was a prudent decision in the current economic context? Dr. Lyons, why don't we go to you first?
Okay, well, the good news today is that the public finances are clearly still on an improving trend. And the challenge, I think, was highlighted by the fact that the OBR's forecast for the budget finances were £55 billion better today for this current fiscal year than they thought as recently as last October. Admittedly, they're slightly more cautious over the year ahead, partly because the economy will take a hit because of all the problems we've just touched on. But the public finances are on an improving trend. That allowed the Chancellor some room for manoeuvre today. Has to be said, I think he could have done even more today if he so wished. But as the Chancellor made clear, he's worried about the impact of higher inflation and higher interest rates in terms of future debt servicing. But in terms of the fiscal rules, I'm not really a big fan of the fiscal rules. We've seen many previous chancellors announce fiscal rules which have not stood the test of time. But the necessity they feel is that they have to keep the financial markets on side in some way, shape or form, and the fiscal rules help do that. So the Chancellor's fiscal rule is to basically have the current budget in balance and to actually reduce debt to GDP over time. I think both of those make sense. And indeed, I think one looks at the debt to GDP figure it's clearly on an improving trend. And in my mind, it suggests that we shouldn't panic about the public finances. It also raises the question as to whether it was right to have increased national insurance in the first place. And it also raises the question about growth that Ruth just touched on. The key to the public finances is undoubtedly the growth profile of the economy. If the economy is improving or if growth is much higher, then the public finances get into shape far quicker. If growth is disappointing, then that starts to tie the Chancellor's hands. So I can understand why he's stuck to his fiscal rules and why he has the fiscal rules, but I hope that he's not going to be bound by those all the time if we get to a period of increased difficulty over the next 6, 12, or 18 months. But for now, the finances are improving, hence he was able to give a few things away today in terms of specific targeted measures.
Thank you. And Ruth?
Yes, I think the Chancellor was today trying to set out his stall as a fiscal conservative and as a tax-cutting Chancellor. So many Chancellors would have been tempted, perhaps rightly so actually, to try and cushion the blow of the intense cost of living squeeze, particularly on poorer households. And now clearly Rishi Sunak went some way towards tackling that, but actually he was more concerned with banking most of the windfall gains he has seen from higher price rises that have boosted revenues for the Exchequer very significantly in the current financial year and have also boosted revenue in years beyond that. So most of those were banked, and one penny promised off the rate of income tax in 2024, which was a signal that once he has the fiscal stance under control, then people are likely to see more tax cuts. In fact, I'm sure he hopes that he'll be able to go further, depending on the timing of the next election, of course. So he chose to set out his stall, to keep his fiscal rules in place. And that shows, I think, that he's not just got a clear economic, personal economic vision, but also is quite a political chancellor, trying to sort of play the long game rather than court immediate popularity.
That's a really interesting point about the fiscal rules and setting out the stall. And I suppose one of the questions I have is that we know that according to the OBR, inflation is likely to peak at around 9% in Q4 of this year. And if I'm in the Treasury, I suppose I'm thinking that will inevitably mean that the Bank of England will have to raise interest rates, and that will be a drag on growth, and that will cause a degree of economic slowdown, because that's generally what interest rates do. In terms of my future economic planning, Ruth, you used to be at the Bank of England, and Gerard, I think you were in line, perhaps looking to be governor at one point. How do you, as a chancellor, kind of price in what you think the Bank of England is going to do? And yes, the Bank of England is entirely independent, but what do you think that relationship is like when inflation is now becoming a significant political and economic issue in the way that it hasn't for the last few decades, quite frankly? Ruth, why don't we start with you on that?
I'm sure there are intense discussions, not least because the Treasury is represented directly on the Monetary Policy Committee that makes these decisions on interest rates at the bank. And the conversation they'll be having, most of all, is whether these price rises are likely to keep on going up, as it were, or whether they will stabilise at a high level and inflation therefore start to fall. I think people sometimes think that interest rates are going to rise faster than they might. Partly because the Bank of England at the moment thinks that some of these price rises that prices will stabilise and then start to fall over the next 2 to 3 year period. And if they are convinced that these price rises are transitory, they won't take too much action to try and stem demand, as it were. What they are worried about is that price rises change people's expectations of future inflation, and that feeds into wages. That's something they definitely don't want to see, and are likely to take some action to try and make that less likely. But you're right, this is a very big issue for the government. It's going to have to pay more for its debt, something that Rishi mentioned directly. It's not an easy thing to spend when interest rates are high for the not least for the government. So it will be something that it's clearly taking account of.
Yeah, in terms of the Chancellor, there's a sort of preset process by which the Treasury and implication the Chancellor take into account both the OBR's economic forecast, and they take into account what the market is expecting on interest rates. Naturally, the market is heavily influenced by not only the economic data, but also their read of the Bank of England itself. And Ruth's right, the Treasury has a representative on the MPC, although that representative does not vote and doesn't necessarily speak at the meetings, or it's certainly not always minuted, shall we say. But the point is that when one looks ahead, even though the Bank of England is independent, as we see in terms of today, there needs to be some sort of consistency between monetary and fiscal policy. Inflation is the real challenge impacting not only people, but also the Chancellor and his forecast. Now, the Bank of England last year, I felt, was slow to act. It was already quite clear last year that the economy was recovering, that inflationary pressures were building, yet we saw policy rates kept at very low level, and we saw quantitative easing on a significant scale. Of course, with the economy now being hit by a cost of living crisis, that in some respects constrains the ability for the Bank of England to aggressively hike rates. So the likelihood is that we will see further tightening. I think today's fiscal measures plus the war in Ukraine will not change the direction of interest rates and the direction of monetary policy, which is to tighten. But both of them will influence both the speed and the scale of the likely monetary tightening, if anything, slowing it. But the direction of rates is up. And to conclude, maybe one of the interesting issues is to look back at the last few months and one of the debates in the markets. Financial markets are wondering where so-called R star is, where R star is neutral interest rates are. We've been used to interest rates being close to zero for all sorts of reasons that we've been hit by a combination of shocks. But the markets are assuming that R star neutral rates will be around 2%. But if in future years we're likely to see inflation around 2% and growth around 2%, as Ruth alluded to, then nominal GDP will be 4%. And the question might start to be raised as to whether interest rates don't just rise from current very low levels up to 2%, but whether they could go even higher than that. And I think it's that uncertain backdrop that makes the Chancellor particularly cautious and makes him very keen to continue with trying to get the public finances back into shape.
That's a really interesting point, and I think it speaks to kind of the wider set of huge, quite unanswered questions that face kind of both the British and the global economy. And I'd like to pick up on that point, if I may, about the global economy. We live in, I think, the pandemic and the war in Ukraine have demonstrated quite conclusively how globalized and how dependent the British economy is on wider events happening in the global economy. We've now seen major Chinese ports go into effectively another very strict lockdown, which will have huge effects on global supply chains. Energy prices are going through the roof. In that context, how should the Treasury go about thinking about how to help businesses and how to protect consumers when many of the problems might not be endogenous to the British economy, but are emerging out of exogenous shocks? Should the Treasury be a bit more willing to take measures to dampen market ructions or market volatility than it would in the context where the problem is kind of fundamental to what's happening in the real economy in Britain? And in that sense, in terms of the cost of living crisis, do you think there's a case for the Chancellor to have been a bit more interventionist than he was in the spring statement today? Why don't I throw that to Ruth first?
Yeah, I mean, I definitely think you're right to say these are international shocks, imported price shocks, really, that the UK economy is grappling with, not least through oil and the war in Ukraine, and supply shocks still coming from COVID and supply chains. So these are unprecedented in their severity and affecting all countries. And no doubt the Chancellor is when framing his budget, was very aware that the outlook is so uncertain that there may be future calls on his budget that he wants to be in a position to be able to meet if it's called upon. So, for instance, he didn't do anything to increase the defence budget, which many people were calling on him to do. He didn't put any more money into the public sector in general, knowing that there are intense pressures on public services at the moment, which he may be under pressure to meet in years to come. Although he kept his national insurance rise for the NHS, he didn't increase benefits even in the short term way. Again, to keep, I think, control of the public finances. The one measure he did do, which should have a fairly significant impact, is raise the threshold for national insurance, which will give back 6 billion of the 12 billion that was being sought through the national insurance rise. But that's also a long-term tax reform measure that many people have been calling for on its own merits, as it were. So he was determined, I think, to try and keep control as far as possible, and to sort of build up a war chest which will enable him to meet future priorities.
Well, in the wake of the global financial crisis, we moved to unconventional monetary policy. Initially, that really helped, but it sowed the seeds of many subsequent problems. As a result of this pandemic, we've effectively moved to unconventional fiscal policy, and the Chancellor has stepped in significantly to help different parts of the economy. I think what we now need to focus on is the supply side agenda. And indeed, the Chancellor alluded to that at the end of his statement, and Ruth alluded to that in one of her earlier answers. The whole supply side agenda means really raising trend rate of growth, investment, addressing skills gaps, and basically growing the economy. But for the moment, and as we saw today, the imminent and immediate focus is on addressing the cost of living crisis and cushioning it as much as possible.
Fantastic. And maybe one last question for you, Gerard. In the context of the supply side agenda, is the Chancellor's proposed tax plan, do you think it will be ambitious enough? And do you think it will do enough to actually get Britain on a higher productivity, higher growth path in the future?
Yeah, in some respects, the Chancellor was on the hiding to nothing, not just today, but in recent statements. We've been hit by a combination of shocks. Now, against this backdrop, he has a limited number of options. He can continue to borrow. He could have austerity. He could have tax increases, or he could try and grow the economy. Now, austerity has effectively been ruled out as a result of Chancellor Osborne, and correctly so in my view. So what the Chancellor, Mr. Sunak, would say is that he's combined borrowing, tax increases where necessary, and now trying to grow the economy. What I think we really need to do is focus even more on growing the economy. As we pointed out in previous research from Policy Exchange, while we need to take seriously the need to get the public finances back into shape, we do have some room for fiscal manoeuvre. And indeed, that was reflected somewhat today by the Chancellor. So I think his fiscal plan has to be very much aimed at not only taking measures that continue to get the public finances back into shape, but take measures that continue to allow the supply side of the economy to start to actually get into better shape. So reducing debt to GDP gradually over time is the aim. I agree with that. He wants to cut income taxes before the next election. I agree with that. But there's lots of other things that need to be done. And maybe to conclude, the most welcome change today was simplifying parts of the tax system by bringing both sets of national insurance and income tax allowances into line. I mean, simplifying the taxes system should be a key focus of his future stance as well.
So I want to just pick up on that supply side point. Ruth, one of the things I found really interesting about the statement today is the Chancellor has the new culture of enterprise. He speaks about, I think, the three kind of keys to that, which is people, ideas, and capital. And he in the part of the statement where he spoke about his tax plan, he went into quite a bit of detail about ideas. He went into quite a bit of detail about capital, but actually the bit about skills, the bit about people, about how you can change the tax system, it was actually quite a bit less detailed, and there was a lot of indication that the government was planning on consulting heavily on that. They do want to reform the levy, but they're going to consult businesses. They do want to see how the tax system can change to incentivize better training by businesses. This is one area where British businesses tend to underinvest relative to their international peers. So I suppose my question is, do you think the fact that there's wasn't a lot of detail in that portion of the statement is an indication that actually skills policy is a problem that's bedeviled the British economy and the British government for a long, long time, tons of policy churn? And kind of, you've been Pro-Vice Chancellor of a university, you've been heavily involved in the skills agenda, you were formerly Secretary of State for Education. What are your kind of top tips for the Chancellor as he embarks on this tax plan to encourage skills investment? And what are some things that the government could do now to really drive that agenda forward?
So before I answer that question directly, which I will do, what the Chancellor's really trying to do here is to increase the trend rate of economic growth in the country and tackle the productivity gap. Now, that is something that Chancellor after Chancellor after Chancellor have been trying to address through all the political complexions. And some of it is probably to do with business uncertainty and the fact that businesses have just not been investing at the scale that you'd like them to invest. And arguably, the whole debate about Brexit had an effect, but certainly COVID will have had a significant impact. And now, of course, events in Ukraine and with the energy market. But sort of beneath all of that, there are big issues about how to support innovation and R&D and skills, which the Chancellor, I think, is right to focus on. But as I said, these are endemic long-term problems that, despite quite a lot of tinkering with the tax regime and with the apprenticeship levy and so forth, haven't sort of risen to the scale of the challenge that exists. On the skills agenda, the government has rightly recognised that the FE sector has been the Cinderella of the education system for a very long time. FE investment in further education has lagged way behind investment in the higher education or the schools sector. That may now start to be addressed, but you also have to tackle what and how businesses and employers react to the skills agenda. The real trick here is to get employers not only to invest in skills, but to invest in the right skills and to join up as far as possible in a coherent fashion with the FE and HE sector and with people in their own workforce who need to be upskilled. And that's a very, very difficult thing to pull off. So I'm very pleased the Chancellor is consulting on how the apprenticeship levy, for instance, may be reformed, because at the moment it's really being used only by a minority of businesses. It's very difficult for small businesses to access. It's often being used for higher level skills rather than for intermediate level skills. And the relationships don't necessarily exist, don't necessarily tie in to the skills that have been created. In other words, the people who gain the qualifications don't necessarily meet the demands directly of the employers who try to engage them. So there's a whole set of issues there, some of which may be helped through reforms to the tax credit system and the apprenticeship levy, but it really is a significant issue for the medium and long term of productivity in this country.
Thank you. That's a very wide-ranging answer, and one I think that adequately, quite well captures the depth of the problem. So thank you very much for that. Thank you both, actually, for a really fantastic conversation, some really, really insightful answers, and hope to speak to you again soon. So thank you very much.